Today, the RBA's gotcha moment has real-life consequences. Hello again, it's Martin North from Digital Finance Analytics. Well, I've noticed posts covering finance and prop news with a distinctively Australian flavour. Weirdly, last week, when the RBA lifted the cash rate and said they were embarrassed about their inability to forecast accurately, it was also the week when the quarterly statement on monetary policy was released. And in that statement, the Reserve Bank updated its economic forecasts, some of which it flagged on Tuesday when it lifted the cash rate for the first time since 2010. Actually, Lowe has pretty much now accepted the financial market's expectations for 150 to 175 basis points of hikes this year. Others, like Goldman Sachs, though, have suggested the RBA could hike as much as 260 basis points by the end of 2022, which would take a real-life variable mortgage rate from 2.25% to more than 5%. Now, of course, that would be Armageddon. Banks have already lifted their 3-year home loan rates from below 2% 12 months ago to 4.5% now, and non-bank lenders are under considerable pressure to reprice their costs of funding, and that translates to higher rates ahead through the mortgage-backed securities system, especially given the recent Federal Reserve statements that will flow on into financial markets in the way of rising rates. Now, some suggest it's perhaps hard to imagine the RBA tightening financial conditions once it's swiped, say, 10% off Aussie households' most valuable assets. But if not, households could see their paper profits fall in aggregate by perhaps $1.5 trillion ahead. And we're talking GFC-level fallouts then, as I discussed on Today Yesterday.
Welcome back this Saturday morning. It's great to have your company. With the fallout from the Reserve Bank's interest rate rise expected to ripple through the property market for some time, some economists are drawing comparisons to the housing crash that sparked the global financial crisis in 2008.
For more, we are joined by economist Martin North in Wollongong. Good morning to you, Martin. So what do you anticipate? Do you think we're going to see these widespread defaults in Australia similar to what we saw in the US in 2008?
Well, I think there are some important differences, but also some parallels. So back in the US in 2008, there were a lot of adjustable rate loans. In other words, mortgage rates going up very high and very quickly. And that put about 11% of households effectively in default and created a huge set of pressures. Here we've got a rather different story insofar that we already have a lot of people under mortgage pressure, and those rates are going up. So the real question is how fast they go, how much it really impacts households. But, 42% of households already have cash flow issues. So whilst it may not be precisely the same as the US, I think there are some very important parallels. I'll make one other point, though, that in the US, you can just walk away, hand your keys over, whereas here you have full recourse. So even if you want to sell and get out, you still have the mortgage to pay, and that will make a difference.
Yeah, if not directly to the US then, there are parts there. Can we draw similarities from other places around the world to look at what's happening here?
Well, I think Ireland, around the global financial crisis, is probably a better analogue insofar that there, property investors ran for the exits almost immediately. They did a review a few days later and said, actually, property investors decided to sell and sell quickly. I think we could see some of that. But also there was a long tail of construction that left a lot of people also in difficulty. We've got a similar issue there. So in a way, Ireland is a good analogue. Their property prices dropped between 35 and 40%. Or look at New Zealand. New Zealand already has a cash rate at 1.5%. They started lifting last year. And the bank over there is forecasting a price fall of around 20% and higher defaults. So in a way, you could say that New Zealand is, 6 months ahead of us. And I think that's a good analogue too.
So if here in Australia, 42% of households already have cash flow problems, how soon could things get really bad?
Well, I guess if we can read into what the Reserve Bank said recently, rates are going to continue to rise this year, and cash rate could be 2%, 2.5% higher by the end of the year. That would mean that most mortgages will be 2% higher. That's going to take a few months to work through, and I think probably later in this year, September through to December, we'll really get a read on how much this is really impacting households. Now, many households have buffers. Many households will be able to trim their spending elsewhere, but I'm concerned about those who are already right up against it. Their incomes are not growing, their cost of living are going through the roof, and now the mortgage is going up. And just to give you a bit of a sense, if rates went up 2%, that is a 30% increase in your average monthly mortgage repayment. That's a big deal. So I think later this year we'll see how this plays out. But I do expect prices to start sliding earlier than that.
You mentioned the buffers, and the housing market has been phenomenally resilient in the last few decades. Really quickly, if you're in charge of the Reserve Bank, what do you do?
I think, firstly, you've got to tighten lending standards. Banks need to make sure that households are really able to ride this out. Secondly, I think we need to be understanding they have to lift rates because of tackling inflation, so rates are going up. And I think the third thing is we need to just spread the word that households need to be a little bit more conservative, manage their priorities in terms of their spending, and make sure that they can plan now for what's coming ahead.
Yeah, some great advice this morning, Martin. Thank you. Everyone waiting for those wages to go up as well.
Jump as well.
Overall, this is a mess. And remember that even before these latest events, both major political parties were supportive of an external review of the Reserve Bank after the election. And while the proposed focus from the bank was about their handling of the response to COVID and their failed yield curve control policies, actually, the central issue that any review needs to examine are questions of governance and why the RBA consistently misses its targets and how this can be avoided in the future. And perhaps even there should be a question of the role of the central bank. Now, of course, this has real-world consequences, and Christopher Joy recently observed that it is not just that the Reserve Bank's forecasts have been pathetically poor, it's that the Reserve Bank has then lurched into huge multi-year policy pre-commitments on the basis of these specious perspectives. Recall the commitments to not raise rates until 2024. That was also accompanied by the promise to keep buying the 2024 government bond yield to ensure its yield remained equal to 0.1%, which was the cash rate, and more recently the pre-commitment to wait for the May and June wages data before increasing rates, ruling out a May move. All of those promises have been completely overturned, and in so doing has blown up the Reserve Bank's credibility, which was pretty weak anyway, by the way. Joyce said, despite admitting that his economists could not forecast their next footstep, Lowe then repeatedly told the world that the RBA expected to lift its cash rate to a 2.5% neutral rate. Over and again. Now the question, of course, is on what planet can the RBA have confidence in these expectations? Why ever even utter those words? What's happened to just being data dependent? Now, all of this tells us that the RBA has learnt nothing about the perils of pre-commitments. It demonstrates that it is not yet willing to concede defeat about its deep intellectual deficiencies. It cannot help but reflects into pretending to be an all-seeing, all-knowing diviner of our destinies. And, of course, the media then kowtows to Lowe and just parrots what he says. This is a horrible situation where, in fact, the guy at the top of the table actually doesn't necessarily know what he's talking about. The bad news is that the RBA has an especially bad track record of getting the Aussie housing market's reactions to its cash rate changes wrong, so wrong. Home values across all markets have appreciated by 37% on average, although, of course, not all areas and all types of property have moved at the same level. That's since mid-2019, when the RBA first started cutting its cash rate from 150 basis points down to the 10 basis point level that was there before this week's increase. Actually, of course, as I keep saying and keep modelling, credit availability and interest rates drive prices. Credit availability and lower rates drives prices higher, and my own modelling proves that again and again. The real howl of the RBA, and for bank economists, by the way, was that it forecasts 10% plus house price declines during the pandemic, coupled with its inability to anticipate the recovery. The RBA claimed that there will be no housing boom in response to its pandemic policies because population growth was non-existent. By October 2021, though, all regions' dwelling index had indeed increased by 20% in that month. They should have been raising rates then. Whether the RBA wants to admit it or not, its interest rate decisions will be heavily influenced by the direction of house prices, which after years of very cheap money has never been more inflated, and that'll be amplified by a couple of dynamics. First, there are hundreds of billions of dollars worth of around 2% fixed loan rates that will roll into variable rate products that carry much higher interest rates in the next couple of years. And second, households are much more sensitive to interest rate changes because the household debt to income ratio is sitting at around 186, in line with all-time highs. Now, Joy projects that the RBA will be likely forced, if it acts prudently, to pause its monetary policy tightening process after, say, the first 100 to 150 basis points of hikes as a result of the start of a record 15 to 25% decline in Aussie home values. And it will also be held back by banks unilaterally lifting mortgage rates out of cycle as their funding costs normalise. Or put differently, banks will do some of the heavy lifting on interest rates for the RBA. And that, of course, underscores the fact that the cash rate and mortgage rates are only indirectly connected. Since the total value of residential real estate in Australia is worth around $9.9 trillion, the RBA will likely impose losses on households worth around $1.5 trillion. That's assuming just a 15% drawdown. And superannuation will also shrink in value as listed equities, infrastructure, property and private equity are all smashed. Now, what makes the RBA's history of housing misses so odd is that its own staff have actually developed an outstanding model of the market, which it did unfurl. It's the Sanders Tulip model for the first time in its latest financial stability review. And in fact, Joy updated the version of the model, and that points to a 33% correction in house prices after a permanent 100 basis point increase in mortgage rates, but his official forecast involves a more modest 15 to 25% correction, which would still be the largest loss in the housing market's history. The risk, though, is that the RBA once again gets wrapped up in its own flawed projections of the future and hikes too hard and fast. Now, in that context, let's look in more detail at some of the information from the monetary policy statement. The Reserve Bank says inflation could exceed its expectations if workers demand higher wages to compensate for increased living costs, as it forecasts the jobless rate to decline to its lowest level in almost half a century. The central bank now expects wages to grow at 3% by the end of next year, 6 months earlier than it forecast in February, and to reach 3.7% in the forecast period to June 2024. The previous forecast peak was 3.25%. But, of course, the point there is that in real terms, wages will be going backwards for the next couple of years. While the majority of layers and contacts continue to report annual wages growth of 3% or less, there has been a marked increase in the share of firms reporting average wage increases already above 3%, they said. The Reserve Bank's decision on Tuesday to increase the cash rate was informed by recent inflation data and also further data from its liaison program, in which it surveyed firms that reported a sharp increase in wage demand expectations. About half the firms surveyed expected to increase wages by more than 3%, and almost all firms expect to pay workers more than 2%. Well, we'll see whether that comes true. The Reserve Bank set a high level of job vacancies as a time of high participation in the labour market led it to forecast a fall in the unemployment rate to around 3.5% in early 2023. That would be the lowest level in almost 50 years. And relatedly, in tight labour markets and given high and rising inflation, workers might seek larger wage increases to compensate for the loss of purchasing power. But it's difficult to predict how successful those efforts will be, and if they are, how quickly that could occur, the Reserve Bank said. These uncertainties are salient in Australia, where there is little recent experience of how the labour market inflation might behave when unemployment is as low as it is currently. And the May statement on monetary policy provided an update in economic forecasts, some of which were flagged in the Tuesday statement. It now expects the jobless rate to hit 3.5% by early 2023. Headline inflation will hit 6% later in this year, and the underlying inflation will hit 4.75%, way above their target. Inflation is then expected to moderate to about 3% by mid-2024, and that's the top of the bank's 2 to 3% target band. As some of the current cost pressures reflect supply bottlenecks domestically and abroad, and the likely to moderate over time, headline underlying inflation are forecast to return to the top of the 2 to 3% target range by the end of the forecast period, the Reserve Bank said. That's years away, of course. Whilst it might be convenient to argue that most of the inflation is driven by supply chain disruptions, the truth is that both grocery prices and also rents are also rising significantly faster than expected. And that means that local inflation will continue to be a long-term problem. And although there are significant changes in wage and inflation forecasts, the Reserve Bank's GDP outlook happened to be little changed from February. This, of course, begins to underscore a disconnection now between what the Reserve Bank is saying and those projections that were in the Treasury numbers, which, of course, are forming the foundation for the current election campaign. No change, though, there from the campaigns at heart at this stage. The central bank still expects growth to moderate from 4.25% in the December quarter to 2% in 2023 and 2024, as extraordinary policy support is withdrawn, rising prices weigh on real income, and consumption growth slows to more typical rates. So it's very important to understand here, we've got nearly $8 trillion of debt piling up, and we're going to end up with a 2% growth rate. After all of that, this is disgraceful. In developing its updated economic forecast, the RBA assumes the cash rate will rise from 1.5% to 1.75% by December this year and keep rising to 2.5% in 2023. That figure is a blended estimate of both the market and economist forecasts of the expected future cash rate. And the forecast for household consumption were also little changed and expected to decline from 5.8% in 2022 to about 3% in 2023 and 2024, as rising prices and higher net interest payments weigh on real income growth and housing prices moderate. So you can see here that this flows through to less disposable income for households, spending less, lower growth, and falling house prices. So the RBA Governor Phil Lowe said it is appropriate to start the process of normalisation of monetary conditions after increasing in the March quarter to levels significantly above pre-pandemic norms. The housing saving ratio is expected to decline over the remainder of the forecast period, the RBA said. And the RBA said that consumption growth will be weaker than forecast if rising inflation interest rates weighed on asset prices, or could be stronger if households spent the large savings they'd accumulated during the pandemic. And it's worth underscoring again, of course, that the distribution of those savings is not equally spread across all households. 42% of households in my surveys are already under financial flow pressure, and this will get worse. Now, standing back, Dr. Peter Tulip, the chief economist at the Centre of Independent Studies, released a paper about the structural reform of the RBA, which was published last week. He, of course, previously worked at the RBA as well as at the US Federal Reserve and the OECD. And he said that for most of the past decade, the RBA has been unwilling or unable to attain its targets. Underlying inflation fell below 2% for over 5 years and would have done so for longer if not for the pandemic. So resetting the target is beside the point. It's like a cricket coach telling a bowler which stump to aim at when the bowler didn't even land the ball on the pitch. He says the central issues any review of the RBA needs to examine are questions of governance. Why did the RBA persistently miss its target, and how can that be avoided in the future? A major factor was that monetary policy targeted financial stability, often called leaning against the wind. The RBA claimed that low interest rates would increase indebtedness, and this would make household spending volatile. This argument has multiple flaws, contrary to what the RBA asserted. Research finds that low interest rates are about as likely to lower the debt-to-income ratio as to increase it, and low rates increase net wealth and after-interest disposable income, and thereby reduce the sensitivity of household spending to shocks. And even in contrived worst-case scenarios, indebtedness has tiny effects on aggregate household responses to external shocks. More serious than the analytical errors, though, are poor process. This argument about financial stability was never fully explained or defended. The relevant research was not discussed. Counter-arguments were not addressed. there was no scrutiny. So even if the RBA was wrong, which it was, how would it find out? There is no process by which mistakes can be identified, let alone corrected. So the mistakes persisted. And this is not an isolated example. The RBA has a track record of analytical error compounded by resistance to review. Paul Keating recently pointed out the Reserve Bank's culture of indolence. It has repeatedly responded too slowly and weakly to emerging problems. Perhaps the RBA's most egregious mistake was its targeting of the current account deficit in the late 1980s. Warwick McKibben, then on the staff, was pushed out when he tried to criticise this policy. One partial remedy would be to appoint more monetary policy experts to the RBA board. Most current board members are non-economists who do not have the training to ask. But, Governor, doesn't the research say the opposite? Having board members capable of challenging the governor is important, but that's not enough. They also need an incentive. That means individual accountability and identified votes. Board members should publicly explain their views on policy and where they agree and disagree. At present, decisions are by consensus. This is undoubtedly comfortable for the governor, who has his decisions rubber stamped, but consensus stifles innovation. It promotes groupthink, insularity, and status quo bias, leading complaints about the RBA. Greater scrutiny of RBA decisions should not be purely an internal matter. The bank would make fewer and less persistent mistakes if it was more transparent. The country's wisdom on monetary policy is not confined to Martin Place. A transparent and accountable central bank would fully explain its decisions, but that does not happen. Minutes and statements following board decisions rarely discuss the pros and cons of alternative choices. The expected consequences from alternative paths for interest rates are not estimated or even discussed. A transparent and accountable central bank would also explain unsatisfactory outcomes. Where is the bank's explanation of why it persistently missed its targets? Dwelling on errors is often uncomfortable and embarrassing, which is presumably why the RBA does not want to do it. But learning from mistakes is in the public interest, so quantitative post-mortems should be required. And in summary, RBA decisions need more scrutiny. This can be achieved by appointing more experts to the RBA board, making board members individually accountable, and requiring greater transparency. But I also think there's a very important role here for the mainstream media, who need to start asking the hard questions about why things are the way they are. Because if you listen to any of the questions bowled at the governor, they are, well, very benign. And the governor is still on some sort of pedestal. He is effectively the voice of God, talking about stuff that nobody else understands and claims to have perfect insight, when of course he doesn't. So this is a very important opportunity to really think again about the role and purpose of a central bank in Australia. And I have to question, do we need what we've got now? What do we need? And how should it be governed? These are questions that the review should be thinking about. The Reserve Bank has done us very badly over the last 20 years. And as a result of that, households are going to find the next couple of years in particular extremely uncomfortable. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.